When it comes to building a portfolio that has the ability to build wealth over the long term, you'll often hear many different investors say the same thing. It always starts with having a strong backbone to your portfolio. One way to do this is by being diversified, and the easiest way to diversify your portfolio from the get-go is through ETFs, or exchange-traded funds. ETFs give you the ability to have ownership in hundreds or even thousands of different stocks. So in today's video, we're going to take a look at two of the most popular dividend ETFs to determine which is the better buy. We're going to take a look at the Vanguard Dividend Appreciation ETF, VIG, and we're also going to take a look at the very popular SCHD, which is the Schwab US Dividend Equity ETF. So before we get started, do me a huge favor, click that like button down below, subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please perform your own due diligence and do not take this as financial advice. And before we begin, let me take a quick moment to thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. Now let's get back to our video, taking a look at two of the most popular dividend-focused ETFs on the market. And we'll begin with the Vanguard Dividend Appreciation ETF, stock ticker VIG. This ETF is actually the largest dividend-focused ETF on the market today, as they have an assets under management of $66 billion, and it holds them within the top 20 largest ETFs in the entire market. Over the past 12 months, VIG's shareholders have enjoyed a 13% gain in share price, which is good, but has slightly underperformed the S&P's 18% gain over that same period. VIG has traded in lockstep with the S&P 500 for many years. As we can see here in the chart, the total return between the S&P 500 and VIG are separated by roughly 5 percentage points. And VIG has earned itself a gold star rating from the likes of Morningstar. And in order to get that, you need to not only show in the past you've been able to generate positive returns at a higher end, but also that they believe you can do this moving forward based on your strategy. And VIG has done that. Given the fact that VIG over the past 5 years has traded in lockstep to many degrees with the S&P 500, that tells me one thing, that they likely have a high exposure rate to the technology sector, because if we look, especially in 2023, two sectors have really led this charge. It has been technology and communication services. Checking out the top sectors in this chart, you can see that the ETF has the largest amount of exposure to the technology sector, which makes up nearly 23% of VIG. That is then followed by financials, healthcare, industrials, and consumer defensive. The top 5 sectors make up 81% of the entire ETF. Now let's take a closer look at the top individual holdings within VIG. You see the likes of Microsoft, Apple, ExxonMobil, United Health Group, JP Morgan, Johnson & Johnson, Visa, Broadcom, Procter & Gamble, MasterCard, rounding out the top 10. In totality, they have 318 total positions, and those top 10 positions make up roughly 31% of the entire fund. Now let's take a closer look at these top 3 holdings to give a better sense of where is valuation. Now, just looking at 3 holdings isn't going to tell you the entire valuation story for an entire ETF that has especially over 100 or 300 in this case total positions in it. But let's just take a look at these top 3 positions to see, do they look undervalued or do they look overvalued from an individual standpoint? Let's have a look here at this fast graph chart, which you can see down below. It'll show the average analyst expectations for earnings moving out over the next few years. This gives Microsoft, looking out over the next 12 months or so, a forward price to earnings multiple of 28.8 times. When you compare this to their 5-year average of 32.3 times, Microsoft shares might look a little intriguing. Apple, on the other hand, trades at a forward price to earnings multiple of 26.2 times compared to a 5-year average of 25.4 times. So slightly overvalued from that technical standpoint there. And then lastly, we have ExxonMobil, which is trading at a forward price to earnings multiple of 12.5 times compared to a 5-year average of 16.1 times. Although Microsoft does look undervalued from that standpoint, I think the 28.8 times or so where they're at right now is pretty fairly valued, I'd have to say, because the 32.2 times was during a huge boom that we saw in the technology sector, including 2023. Now that boom is going to continue moving forward, but at a multiple of 32.2 times, that just seems a little frothy to me right now. So I like where Microsoft is right now. Wouldn't really call it undervalued or overvalued. Now let's take a closer look at VIG and the strategy behind this ETF. The ETF was formed back in 2006, and as you could probably guess, it is managed by the Vanguard Group. The fund seeks to track the performance of the S&P U.S. Dividend Growers Index, which measures the investment return of common stocks of companies that have a record of increasing their dividends over time. In terms of that dividend, shareholders currently earn a dividend yield of 2%, and over the past 5 years, shareholders have seen that dividend grow at an average annual clip of nearly 10%, and the dividend itself has grown for 9 consecutive years. Now let's move on to our other dividend ETF that we're going to spotlight today, which is the Schwab US Dividend Equity ETF, also known as SCHD, which has largely become one of the most popular, if not the most popular dividend ETF on the market today. Now, they're not as large in terms of assets under management. Right now, SCHD has $47.5 billion in AUM, nearly $20 billion below that of VIG. SCHD, though, is on the verge of passing VYM, which would make them the second largest dividend-focused ETF behind VIG. Over the past 12 months, shares of SCHD have underperformed, climbing only 5% over that period. But we will talk more about that here in a second. The underperformance is rare for SCHD because if you look back over the past 5 years, SCHD has actually been outperforming the S&P 500. Due to the underperformance we have seen over the past 12 months, the S&P 500 has taken a slight 1% lead over SCHD looking back over a 5-year period. That is actually more impressive from SCHD's standpoint. Like VIG, SCHD also receives that gold star rating from the likes of Morningstar. They have a strong track record looking back, and based on their strategy, Morningstar believes that strong success rate is going to continue moving forward. Now, knowing the underperformance with SCHD, that tells me one thing right off the bat. Their sector, if we look at their sector performance here in a second, I don't expect technology to be one of the top 2 sector exposures. So with that being said, looking here, you can see exactly that. Technology is actually the 5th largest exposure rate within SCHD. It is a very broad-based ETF led by industrials, healthcare, financials, consumer defensive, and then technology. Knowing that now, that speaks a lot to the underperformance we've seen in 2023. The big gains in 2023 have really been led by those 2 sectors, technology and communication services, which communication services accounts for only 4.5% of SCHD. So again, not a ton of exposure there either. But if we get a healthy, broad-based rally, that's when SCHD is going to outperform. Now let's take a closer look at the individual positions, the top 10 individual positions within SCHD, which include Amgen, AbbVie, Chevron, Merck & Company, PepsiCo, Broadcom, Verizon Communications, Coca-Cola, Texas Instruments, and Cisco Systems. These top 10 holdings account for 40% of the entire ETF, and in totality, SCHD has 104 total positions. When you're looking at these top 10 holdings, only Broadcom, Texas Instruments, and Cisco Systems would categorize themselves under technology, and those last 2 are spots 9 and 10. Now let's do the same thing we did for VIG and take a look at the top 3 positions for SCHD and how their valuation compares to their historical averages. Beginning with Amgen. As you can see down again at the bottom, you see their analyst expectations for the years coming forward. Amgen trades at a forward price to earnings multiple of 13.7 times. This compared to their 5-year average of 14.1 times. So Amgen appears undervalued based just solely on forward price to earnings. Now looking at AbbVie, they trade at a forward price to earnings of 13.5 times. This compared to their 5-year average of 11.7 times shows that the stock might be slightly overvalued. And then lastly is Chevron, which trades at a forward price to earnings multiple of 11.7 times compared to a 5-year average of 14.3 times, suggesting shares are undervalued. So again, 2 of the top 3 positions here are trading below their historical averages. In terms of the dividend, SCHD is very unique because they're not really a high yield dividend ETF, although they trade with a yield that's much higher than high yield dividend focused ETFs like HDV or VYM. SCHD currently has a dividend yield of 3.7%, And over the past 5 years, they have a 5-year CAGR of nearly 14%. And the dividend has grown for 11 consecutive years. So when it comes to SCHD, not only do you get a broad-based portfolio, but you get a high-yield dividend in many ways that's higher than high-yield dividends. You also get dividend growth. You get the best of both worlds when it comes to SCHD. But right now, the underperformance is solely due to the fact that they have a lower technology exposure. So if they can increase that a little bit, I think this would really get moving once again. So when it comes to both of these ETFs, VIG and SCHD, which do I like better? In my opinion only, I'm going to side with SCHD. The track record is there. You could see over the past 5 years. Yes, in 2023, the underperformance is there solely due to the fact that they don't have the exposure rate to the technology sector. Might that change when they rebalance and do their reconstitution moving forward? Sure, that would be great. I think moving up technology to a top 3 positions is a smart thing to do. Now, VIG, again, I like both of these ETFs. I own both of these ETFs. VIG more focused on dividend growth, but as we saw, SCHD has a higher dividend growth rate. Now, SCHD also has a higher dividend yield from that standpoint as well, a higher dividend yield than some high yield dividend ETFs. So that's why I'm going to side with SCHD. I think there's a lot more value that comes along with SCHD right now. So down in the comments section, let me know which of these dividend focused ETFs do you like better? Or do you have another one that you think is better than both of these? I would love to see that down in the comments section below. And if you haven't done so yet, make sure you smash that like button down below, as it really helps out the growth of this channel moving forward. I appreciate all the support, and we'll see you in the next video. Take care.